Hello everyone and welcome back to the sessions on strategic financial management. Friends, in this class of CA Final SFM, we are continuing with the topic mergers and acquisitions, and this is the second lecture on this topic, mergers and acquisitions. So we are going to observe and face different varieties of questions today, and once we cover up back-to-back 3 questions filled with lots of new concepts, then we shall move ahead and practice out some more questions, what exactly we did in the previous class. So let us do one thing. Let us begin with question number 12. Let us read this question. Consider the following data for the two companies, Acquirer Limited and Target Limited. What has been given is number of equity shares, market price per share and price earning ratio. Acquirer Limited considers acquisition of Target Limited and offers for a stock swap on the basis of market price. However, Target Limited demands the stock swap on the basis of EPS. It was finally negotiated to provide to the shareholders of Target Limited the average of lower and upper limit of number of shares determined as per the two modes mentioned above. It is expected that the overall profit of the merged entity will increase by 25% due to effects of synergy. Assuming that the PE ratio of Acquirer Limited remains unchanged after the merger, you are required to determine the following. Number 1, swap ratio and the number of shares to be issued as consideration, followed by post-merger earnings per share and equivalent EPS for shareholders of Target Limited. Then they have further asked post-merger market price per share, gain or loss in value to the shareholders of both the companies, loss in earnings for shareholders of Target Limited. Considering the synergic effects, are the shareholders of Target Limited better off on the basis of the following parameters? Number 1, market capitalization, and number 2, total earnings. So friends, before we approach the solution, let us first understand the given scenario in this question. If you carefully look into what has been given, the question is giving you 2 new points which you haven't seen earlier. Point number 1, you would see that the acquirer is offering a stock swap on the basis of prevailing market prices. On the other side, the target company, it is demanding the stock swap on the basis of EPS. That means they both are not able to arrive at a common consensus. As a result, they have finally negotiated that whatever be the number of shares from both the bases, let the number of shares to be issued be the average of the two different number of shares what you have obtained by 2 different modes. So what happens? Generally what you have seen in the past, when the acquisition is on the basis of market price, what happens to the shareholders of target company after merger? We have seen that they generally suffer with loss of their earnings, correct? And therefore, for being indifferent with their earnings, they would always demand more number of shares, and generally they would demand the stock swap on the basis of EPS. So what will happen when you apply the stock swap on the basis of market price per share? You will be getting lesser number of shares to be issued as a consideration. On the other side, when you consider EPS as the basis of acquisition, the number of shares to be issued as a consideration will increase. So now this question is talking about these 2 different number of shares as lower limit and upper limit. Lower limit on the basis of market price per share and upper limit on the basis of earnings per share. Finally, you will be taking the average of this lower and upper limit of number of shares to arrive at the number of shares to be issued effectively, and that will become the basis of the effective swap ratio for this consideration. That was one different point in this question. Another second different point in this question was, first time we have seen that synergic effect has been informed. So friends, this part is no big deal. I have explained you earlier what could be the meaning of effect of synergy, but let me explain you once again. What happens when the two companies generally working in similar business line, they merge? What will happen? Because of the improved efficiency and economies of scale, or because of the functional efficiency, because of elimination of competition between them, there may be lots of aspects which rises the profitability of the merged entity. In other words, if the acquirer limited was earning X amount of profit, if the target company was earning Y amount of profit, the post merger total earnings without synergy would be X plus Y, but with synergic effect it will be a little more than X plus Y. So here the question is informing you that the synergic effect will be 25% additional earnings. That means whatever be X plus Y, that is the aggregate earnings of the acquirer company and target company on a pre-merger basis. On that you add 25%, and finally you come to know what would be the post-merger total earnings. That will become the basis for computing post-merger EPS and all the follow-up calculations. Lastly, they have also asked, are the shareholders of target company better off because of this synergic effect? Considering the synergic effect, what do you conclude? Are the shareholders of target company better off or not? We have to identify that. So friends, other than these few points, this question has all the typical requirements what we have seen in other questions. So let us see how to present the solution. In the solution, we would first begin with the swap ratio based on market price that was suggested by the acquirer company, that is named as Acquirer Limited. So obviously the swap ratio would be market price per share of target company divided by market price per share of acquirer company, and market price per share of both these companies are given as 80 for target and 400 for the acquirer. That would give you the swap ratio as 1/5 or 1:5. That means one share of acquirer company should be given for every 5 shares held in the target company. As a result, the number of shares to be issued on the basis of market price will be the number of shares in target company multiplied by the swap ratio that you have just computed as 1/5. And we have been informed that there are 4 lakh shares in the target company. So 4 lakh into 1/5, that will be 80,000 shares. As I have explained you earlier, this 80,000 shares will be the lower limit of number of shares to be issued. So friends, before we move ahead, write down all these calculations quickly. Alright friends, you would have finished writing all these calculations. Let us move ahead and talk about the EPS. EPS was not informed in the question directly, but we know one thing very well, that the price earning ratio, if you want to find, it is market price per share upon EPS. So EPS can be determined by dividing the market price per share by the price earning ratio. So for the acquirer company, the EPS would be 400 divided by 16, that is rupees 25, and for the target company it would be 80 by 4, that is rupees 20. So now if these are the EPS of the two companies, what is the suggestion or what is the requirement of the target company? Target company has demanded the stock swap on the basis of EPS, and that would mean swap ratio this time will be EPS of target company divided by EPS of acquirer company. That will be 20 divided by 25, or you may simply say 4 by 5. That means 4 shares of acquirer company shall be issued for every 5 shares held in target company. And now we have yet to compute the number of shares in this regard, but first what you do is write up quickly whatever you find on the screen. Alright friends, you would have finished writing all these calculations. Let us move ahead and now determine the number of shares to be issued when the swap ratio is based on EPS. So the number of shares to be issued will always be the number of shares in target company multiplied by swap ratio. So that will be 4 lakh into 4 by 5, because we have just found that 4 by 5 will be the swap ratio based on EPS. You will be finding that the number of shares to be issued will be 3,20,000 shares, and now this 3,20,000 shares will be considered as upper limit. And now what they have agreed, the effective number of shares to be finally issued will be the average of this upper and lower limit. So as negotiated, the number of shares to be issued will be the average of lower and upper limit. That number of shares will be 80,000 shares plus 3,20,000 shares divided by 2, and that comes to 2 lakh shares. Finally, what we find is the total number of shares in target company were 4 lakh shares, and the final number of shares that you are issuing are 2 lakh shares. So effectively the swap ratio will be 2 lakh divided by 4 lakh, that is 1 by 2. So all the calculations ahead, wherever we will need the swap ratio, the effective swap ratio will be actually 1 by 2. So friends, write up these calculations also, and then we move ahead. Alright friends, let us move ahead and take up the other calculations. So we would first arrive at the post-merger total earnings of Acquirer Limited. What we generally do, we take the pre-merger earnings of both the companies, and what we have been informed this time, we don't know the profit of the two companies on overall basis, but we know the number of shares, and we have also determined EPS. Number of shares into EPS will give you the total earnings before the merger. So Acquirer Limited and Target Limited both computed, you are going to take the aggregate as total earnings. Now this same thing could have been the post-merger total earnings, but because of the effect of synergy, you are simply going to add 25% of 3 crore 30 lakhs. That will be 82 lakh 50,000, and finally what we conclude, that post-merger total earnings of Acquirer Limited will be 4 crore 12 lakh 50,000 after considering the effect of synergy. And we will also work out the post-merger total number of shares. That will be the original number of shares of Acquirer company plus the number of shares it has issued for acquire the target company. So it is 10 lakh initial number of shares plus 2 lakh, that will be the additional shares issued as consideration. So post-merger number of shares will be 12 lakh shares. So friends, before we move ahead, write up all these calculations quickly. Alright friends, let us move ahead and take up the other calculations. Post-merger EPS is what we have to determine. For that we need post-merger total earnings divided by post-merger total number of shares. We have now both of these information clearly available. So that will be 4 crore 12 lakh 50,000 divided by 12 lakh shares, and that will be rupees 34.375. The question has also demanded the equivalent EPS for shareholders of target company, and we have been doing this calculation quite a lot of time. It will be post merger EPS, that is this, multiplied by the swap ratio, and the effective swap ratio what we have gathered over here is 1:2 or simply 1/2. So it will be 34.375 into 1/2, that will be 17.1875. Let me once again remind you what you have to do with this equivalent EPS from the viewpoint of target company. This has to be compared with the pre-merger EPS of target company to arrive at gain or loss in earnings to the shareholders of target company. So if you compare, the pre-merger EPS was rupees 20. Even after considering the synergic effect, the equivalent EPS what you find in the hands of the shareholders of target company is less than 20, correct? That means earnings viewpoint, the shareholders of target company are definitely not happy. Anyway, let us move ahead. We will write up those conclusions later, but first we work out the post-merger market price per share. That will be again very simple. That is post-merger EPS multiplied by price earning ratio. The price earning ratio of acquirer company was 16 times. So 34.375, that is post-merger EPS multiplied by price earning ratio 16 times will give you post-merger market price per share as rupees 550. So friends, note down these calculations and then we shall move ahead. Alright friends, you would have finished writing all these calculations. Now, after computing the post-merger EPS and post-merger market price per share, you are ready to determine the gain or loss to the shareholders of both the companies. And this type of calculation we have done quite a lot of times earlier. So what you have to do is determine gain or loss to the shareholders of both the companies. This gain or loss will be determined in terms of value. So the question has asked you both the parameters, that is from the viewpoint of earnings as well as from the viewpoint of value. So we will talk about that earnings little later, but what we have just computed, current market price per share, that is post merger market price per share being rupees 550, how does that benefit the shareholders of both the companies in terms of value? So let me remind you how we do this. We consider the post merger number of shares in the hands of both the companies' shareholders. To that we multiply the post merger market price per share to obtain the post merger market capitalization in the hands of the shareholders of acquirer company as it was originally, and in the hands of shareholders of target company who have now just become the shareholders of this acquirer company. So when you compare that pre-merger market capitalization and post-merger market capitalization, you will come to know what is the difference in value in terms of gain or loss. So let us see how to present the solution. So presenting this part of solution is again as usual. You are going to calculate the gain or loss to shareholders in terms of market capitalization, that you should not forget. And for that purpose, you should first start with the number of shares after the merger. So the acquirer limited shareholder, originally they had 10 lakh shares, and Target Limited shareholders who originally were the shareholders of Target Limited have now become shareholders of this acquirer company, and they have just received 2 lakh shares. So these are the number of shares in the merged entity that both the categories of shareholders are currently holding. And the merged entity in total 10 lakh plus 2 lakh, it is 12 lakh shares. Post merger market price per share 550 we have just obtained earlier in the previous working. Multiplying this, we get post merger market capitalization, and that is 55 crores for acquirer limited, and for Target Limited it is 11 crores. Pre-merger market capitalization, it was 40 crores for acquirer limited and 3 crore 20 lakhs for Target Limited. Now how do we get these? The pre-merger number of shares of each company should be multiplied to the pre-merger market price per share to get this value. And finally, what we find, that because of merger, the gain in value, it is 15 crores gain in value for shareholders of acquirer limited and 7 crore 80 lakhs for shareholders of Target Limited. The merged entity in all has a gain of 22 crores 80 lakhs. So friends, before we move ahead, please take note of this much quickly. Alright friends, you would have finished writing all these calculations. Let us move ahead and write up the answer for the other parts. We would want to now determine the loss in earnings for shareholders of Target Limited. I gave you hint earlier that the pre-merger EPS of Target Limited's shareholder was rupees 20, but the equivalent EPS what we have computed was lower than 20. To be more specific, the equivalent EPS for the shareholders of Target Limited is 17.1875. So there is a loss of earnings in terms of per share, and multiplied by pre-merger number of shares, 11,25,000 is the loss of earnings for the shareholders of Target Limited. So we can conclude one thing very well, that on the basis of market capitalization, the shareholders of Target company are better off, but in terms of their earnings, overall basis, their earnings have got reduced by 11,25,000 in total, and therefore from the viewpoint of earnings, they are definitely worse off than earlier. So write up that concluding part as well. We would say, on the basis of market capitalization, the shareholders of Target Limited are certainly better off due to merger. This is because the total market capitalization held by these shareholders have increased by 7 crore 80 lakhs. Do you recollect? It was 3 crore 20 lakhs earlier, and now it has become 11 crores. So it has increased by 7 crore 80 lakhs. So the percentage increase, if at all you want to find, it will be 243.75% increase. So friends, do one thing, write up this part, and then I'll show you the percentage loss of earnings also. And we would conclude that from the viewpoint of earnings, they are worse off than earlier. However, from market capitalization viewpoint, what you find on screen, they are certainly better off. So write up this part quickly, and then we move ahead. Alright friends, let us move ahead and write up that last concluding part, that on the basis of earnings, the shareholders of Target Limited are worse off than earlier because the total earnings as well as the equivalent EPS has reduced significantly. The percentage loss in earnings will be pre-merger EPS minus equivalent EPS divided by pre-merger EPS. That will be 20 minus 17.1875 divided by 20. By percentage, it comes to 14.0625%. So friends, take note of this calculation also, and that conclusion will be the end of the solution. Alright friends, you would have finished writing these concluding points. Let us move ahead and take up the next question. That is a very important question. Question number 13. The following information relating to acquiring company Abhiman Limited and the target company Abhishek Limited are available. Both the companies are promoted by a multinational company, Trident Limited. The promoters holding is 50% and 60% respectively in Abhiman Limited and Abhishek Limited. Now what is all informed to you? Share capital, free reserves and surplus, paid up value per share, free float market capitalization, and price earning ratio in terms of number of times. Further informed, Trident Limited is interested to do justice to the shareholders of both the companies. For the swap ratio, weights are assigned to different parameters by board of directors as follows: book value 25%, EPS 50%, and market price 25%. What is the swap ratio based on the above weights? What is the book value, EPS, and expected market price of Abhiman Limited after acquisition of Abhishek Limited? Assuming P/E ratio of Abhiman Limited remains unchanged and all assets and liabilities of Abhishek Limited are taken over at book value. Last part, it is asking you also calculate promoters revised holding in Abhiman Limited, free float market capitalization, number of shares, earnings per share, and book value if after acquisition of Abhishek Limited, Abhiman Limited decided to issue bonus shares in the ratio of 1:2 and split the stock as ₹5 each fully paid up. So friends, before we go ahead with the solution, it is very important for you to understand certain terms used in this question. And what I am pinpointing is about free float market capitalization. So let me explain you what exactly free float market capitalization means. What we have learned earlier, market capitalization is the overall market value of the shares of the company. In other words, total number of shares multiplied by market price per share will give you total market capitalization. In almost many questions you have been solving the gain or loss calculation for the shareholders, every time you are generally using the market capitalization to compute that gain or loss. And just in the previous question some time back you have done the same. So you know what is the meaning of market capitalization. Now if there is a promoter or a company which is a promoting company and it itself has retained substantial number of shares with itself as promoters holding, obviously those shares will not be traded among investors in the secondary market because that portion of shares is reserved with the promoters. That means the market capitalization will be the shares held by public plus promoters holdings, that is total number of shares multiplied by market price per share. But when we talk about free float market capitalization, we necessarily mean market capitalization only to the extent of the shares which are held by public in general, in other words which belong to non-promoter shareholding. So friends, that is what we mean by free float market capitalization. One more important thing I would want to convey before we start putting up the solution, that is, in this question also they have come up with three different parameters for determining the swap ratio. One is book value per share, one is EPS, and one is market price per share. To compare the three different swap ratios, you want to do justice to the shareholders of both the companies. Always we have seen that from the viewpoint of market price per share, it is acquirer company which is always better off. From the viewpoint of EPS, it is a target company which is generally better off. So we would want to do justice, and that is why swap ratios from different parameters will first be assessed, and then the question is informing you that certain weights have been assigned. You will be applying those weights and arrive at the overall effective swap ratio as the weighted average of all the swap ratios that you have determined earlier. So that was one typical thing in this question. And let me tell you one more thing, you would see a lot of questions of this same type repeated by ICAI. I would say this particular question is one of the favorite question of ICAI, and the first time it was ever asked, it was this question, and this question was asked for 20 marks. So lot of content over here included. So let us see how to present the solution. In the solution, you would first work out three important calculations starting from book value per share. Understand one thing very well, the question has asked you to determine the swap ratio on the basis of book value per share, but book value per share was not directly informed to you. And friends, how do you determine book value per share? We have learnt in the earlier topics like share valuation and corporate valuation. So equity share capital of both the companies, added to that reserves and surplus, will give you the total equity or the total net worth. That total equity or net worth divided by number of shares will give you the book value per share, that is rupees 500 and rupees 60 respectively for Abhiman Limited and Abhishek Limited. So friends, take note of these calculations and then we shall move ahead. Alright friends, you would have finished writing these calculations. Let us move ahead and determine the market price per share and EPS. Now this is something tricky. Please pay attention. We know the free float market capitalization of both the companies. We also know the promoters holding, right? So whatever be the promoters holding, the remaining part of the shareholding will be identified as non-promoter. Let me give you example by taking this case of Abhishek Limited. Check in the question. The promoters holding in case of Abhishek Limited is given as 60%, and now the non-promoter shareholding will be obviously those shares which are not held by promoters. If promoters shareholding is 60%, non-promoter shareholding will be obviously 40%. And now the non-promoter shareholding has this much market capitalization because this part is not the total market capitalization, it is only free float market capitalization, which indirectly indicates the market capitalization for non-promoter shareholding only. So when you divide 128 lakhs by 40%, you will be getting the total market capitalization of Abhishek Limited. And likewise, if you divide 400 lakhs by 50%, you get 800 lakhs as total market capitalization of Abhiman Limited and 320 lakhs with respect to Abhishek Limited. Once you get the total market capitalization divided by total number of shares, and you get the market price per share. That is market capitalization divided by number of shares. Now, once you get market price per share, the question has already informed you the PE ratio. The PE ratio of both the companies are given as 10 times and 4 times. And now you divide market price per share by PE ratio, and what you get is earnings per share for both the companies. So friends, if you don't identify these calculation bases correctly, you will not be getting the swap ratio correctly, and if swap ratio goes wrong, everything goes wrong. So please take note of all these calculations, and then we shall move ahead. Alright friends, after writing up all these calculations, we shall move ahead and start determining the swap ratios on different parameters as required in the question. So we begin with the swap ratio based on book value per share. Now whatever be the basis, you know one thing very well. In the numerator, you would take the value of the target company, that is Abhishek Limited. In the denominator, you will take the value of acquirer company, that is Abhiman Limited. So first basis being book value per share, it will be 60 by 500, that is 0.12. Second basis is EPS. So here you will take EPS of Abhishek Limited divided by EPS of Abhiman Limited, that will be 8 by 40 or 0.2. So note down these calculations also, and then we shall move ahead. Alright friends, let us move ahead and take the last calculation base, that is swap ratio on the basis of market price. This will be market price per share of Abhishek Limited divided by market price per share of Abhiman Limited, that is 32 by 400 or 0.08. Now once you get the three swap ratios, you are going to take their weighted average, for which the weights are given in the question. If you check, for book value the weight was 25%, for EPS the weight was 50%, and for market price per share the weight was 25%. Applying this weighted average calculation, effectively what you get is 0.15 as your effective swap ratio. Finally, we would conclude that 0.15 share of Abhiman Limited shall be issued for each equity share in Abhishek Limited. So take note of this also, and then we shall move ahead. Alright friends, you would have calculated the swap ratios and the weighted average, and now let us move ahead and deal with the other calculations. So we first have to find the number of shares issued by Abhiman Limited. This will be simply the number of shares in target company, that is Abhishek Limited, multiplied to the swap ratio. So the target company, that is Abhishek Limited, has 10 lakh shares, and the swap ratio being 0.15, the total number of shares to be issued as consideration will be 1,50,000 shares. Immediately after this, we would calculate the post-merger EPS and market price per share. For that, we would first begin with the pre-merger earnings of Abhiman Limited and Abhishek Limited, which will be simply determined by multiplying the number of shares with the earnings per share. So whatever be the aggregate, as there are no synergic effects, the aggregate earnings of the two companies will give you post-merger total earnings. So friends, take note of these calculations and then we shall move ahead. Alright friends, you would have finished making these calculations. Now let us move ahead and compute the post-merger EPS. For that, we would first figure out the post-merger total number of shares. Notice one thing, Abhiman Limited already had 2 lakh shares and now it has issued 1,50,000 additional shares for acquisition of Abhishek Limited. Once you get this, you are ready to compute post-merger EPS, which will be post-merger total earnings divided by post-merger total number of shares. That will be 1 crore 60 lakhs divided by 3,50,000, and that gives you rupees 45.7143. The question has again emphasized on one point, that the price earning ratio of Abhiman Limited would remain same after the merger. As a result, post-merger market price per share can simply be determined by taking post-merger EPS into that price earning ratio of 10 times, and what you get is rupees 457.143 as post-merger market price per share. So friends, note down these calculations as well and then we shall move ahead. Alright friends, you would have finished writing all these calculations. Let us move ahead and write up the other calculations, and we have to first calculate the post-merger book value per share. So again, share capital, it was originally 2 lakh shares of 100 each, that is 200 lakhs, additional 1,50,000 shares issued, the nominal value still being rupees 100 per share, it will be 150 lakhs. So the amount of share capital will be 350 lakhs. Now you should understand one thing very well. Look into the aggregate share capital of the two companies. It was 200 lakhs and 100 lakhs given in the question, but against 100 lakhs of nominal value of capital of Abhishek Limited, you have given 150 lakhs of your own share capital. As a result, that 50 lakhs extra what has been given against the nominal value of share capital will have to be adjusted through reserves. So reserves of Abhiman Limited 800 lakhs, reserves of Abhishek Limited 500 lakhs, and that 50 lakhs has been adjusted over here. If you don't make this adjustment and simply keep it as 800 lakhs plus 500 lakhs, that is 1300 lakhs, it will be an error. So don't ever forget to write up this. And one thing you should be very clear with, as there are no synergic effects, the overall net worth before merger and after merger will be same, because we are still considering nothing but the book values. So as such, book values of assets and liabilities are never going to change. Earlier the aggregate value was 1600 lakhs. You may check the very first working note that you have made for book value per share. There the company wise aggregate was 1600 lakhs, correct? That will never change. And so if you are writing it as a breakup of share capital and reserves and surplus, don't forget to adjust this 50 lakhs over here. Thereafter, the total number of shares post merger is 3.5 lakh shares, and book value per share comes to 457.143. So friends, take note of these calculations also, and then we shall move ahead. Alright friends, after writing this, let us move ahead and write up the calculation of promoters' holdings in Abhiman Limited after the merger. Now please try to understand this calculation also very well. Number of shares held by promoters pre-merger were 1 lakh shares, correct? How 1 lakh shares? The promoters were having 50% shareholding in Abhiman Limited, and Abhiman Limited in total had 2 lakh shares. So 50% shareholding means the promoters were holding 1 lakh shares. Thereafter, the number of shares received on acquisition. Promoters were holding 60% shares in Abhishek Limited, that is a target company, and the total consideration paid to Abhishek Limited was basically 1,50,000 shares, and 1,50,000 shares, the 60% of that will obviously come in the hands of promoters, and that will be 90,000 shares. So finally, the number of shares held by promoters in Abhiman Limited post merger will be 1,90,000 shares, and the total number of shares in Abhiman Limited post merger is 3,50,000 shares. So promoters revised holding can be computed by taking 1,90,000 divided by 3,50,000, and that will be 54.29%. And now you want to know the free float market capitalization as well. That can simply be determined by taking total number of shares minus those held by promoters. So 3,50,000 minus 1,90,000, the balance number of shares will be held by public in general other than promoters, and that multiplied to market price per share will give you the free float market capitalization after the merger. So friends, I want you to write up all these calculations and then we shall move ahead. Alright friends, you would have finished writing all these calculations, and the question further hasn't ended yet. Question is still asking you more and more calculations. Now they are talking about impact of bonus issue and stock split. So immediately after the merger, what they have done, they have come up with a bonus issue. So the number of shares post merger were 3,50,000 shares. Bonus shares were issued in the ratio of 1:2. So now 1,75,000 shares these are basically half of the existing number of shares, because if the bonus ratio is 1:2, you are giving 1 share for every 2 shares held as bonus. So that will be half of the existing number of shares issued as bonus. So total number of shares after the bonus issue will be 5,25,000 shares, and the number of shares issued against each share because of share split will be 20 shares. Why? Because earlier the face value of each share was rupees 100. You are breaking up that by way of a stock split, and you are breaking each share into a share having a face value of just rupees 5 as fully paid up definitely. So 1 share of 100 rupee face value is equivalent to 20 shares of rupees 5 face value. So 5,25,000 shares were when the face value was 100. You need to multiply by 20 to arrive at the number of shares after the stock split. In simple words, 5,25,000 shares were split into shares of rupees 5 each. So 1 share split into 20 shares. So 5,25,000 shares got split into 1 crore 5 lakh shares in total. So revised EPS will be post merger total earnings divided by revised number of shares. So now the EPS drops to just rupees 1.5238. So note down these calculations and then we shall move ahead. Alright friends, you would have finished writing all these calculations. Let us move ahead and write up the calculation of post-merger book value per share. That was also required in the question. Share capital this time will be 525 lakhs. keep one thing into your notice. This is because of the bonus issue. So that bonus issue is nothing but the capitalization of reserves, right? Capitalization of profit. So whatever you have added to share capital, that is 175 lakhs, should be further reduced from the reserves. So 800 lakh plus 500 lakh minus 50 lakh, which came to 1250 lakhs we have analyzed earlier. This 175 lakhs have been removed from reserves and got added to share capital in such a way that overall net worth still remains 1600 lakhs, but the number of shares now is 105 lakh shares. So book value per share post merger will be 15.2380. So friends, take note of this calculation as well, and that will be end of the solution. Alright friends, you would have finished writing all these calculations, and as I said, that was the end of the solution. Now friends, in this session we have solved two very important questions, question number 12 and 13. The practice type of questions of this type will be in the follow-up video, but what I want you to do today as part of your main task at home, thoroughly revise the concepts that you have learned through these. In this chapter, most of the questions will have repetitive same type of calculations. Therefore, catch all the new points that you find in these questions and keep piling up to your concept stock. So let us declare this as end of the session. So this will be end of part 2, and thank you so much for attending the class.